Hello and welcome to the next class on financial management. The course is MBA ZG 521 and my name is Krishnamurthy Bindumadhavan. We are discussing about risk management. This is part 3 of the first segment on risk management, and we will continue the discussion in subsequent sections where we will talk a little bit more about certain other concepts relating to risk management. But in this part 3, we are going to try and wrap up our discussion relating to the quantification of risk, right, as we have been discussing so far. What we have done so far is we have defined returns, right? What is meant by a simple return, how to calculate the return, right? That is the arithmetic return, the geometric return. And then we have seen how to calculate or how to quantify risk, and we did that for both a discrete distribution and a continuous distribution, right? And I walked you through an example of how to calculate it, and I have given you a homework as well, which I hope you have been able to work on. And in Excel also we downloaded the Tata Motors stock prices, and then we calculated the simple returns from that, and then we calculated the arithmetic mean of those. Then we also calculated the multiples, and from that we calculated the geometric mean, right? What we did not do in Excel so far is to actually calculate standard deviation or a metric of a measurement of risk, which we will do in a live class. But as I have mentioned, that was a homework for you. I have given a homework as well, so you should try and attempt it at home at your convenience before the live class. And if you are able to crack it, that's well and good. Otherwise, in the live class, we will explore that further. So moving on, in this particular segment, we are going to discuss about risk attitudes. So what we have done is we have this universe of different investment options, right? We have different stocks out there, right? So let me explain that first. So why are we even talking about risk attitudes? The reason we are talking about this is because what have we done so far? We have said that there are different companies out there, right? There are different investment opportunities out there. Like for example, Tata Motors, for example. We have talked about Tata Motors, we have looked at the data, Tata Motors data which I downloaded from NSE website, right? We calculated the expected return. We have not calculated the standard deviation, which I think you should be able to do on your own, right? But we did look at Tata Motors. We also talked about the Nifty, right? I talked about the Nifty 50 and so on. So like this, there are different investment opportunities out there. And these are all stocks, so stock investments are there. Then there are investments in bonds, there are other investments maybe in commodities also like gold and so on. So there are a number of different investment opportunities out there. And then what? We have the investors here. On this side we have the investors. So of course there could be a number of different investors as well, right? There could be Mr. Ram Prasad, my good friend, who is based in Dubai. So he could be one of the investors. Then there could be, let's say, Mr. Someone else, XYZ, right? Or my good friend John Crenshaw, who is in the US. Okay, so we have different investors here. So how do the investors select from the investment opportunity set? This is the investment opportunity set. This is a set of available investments. How do they choose? I mean, along here, somewhere here will be the bank deposits, right? Will be bank deposits also, maybe bonds, right? And there could be gold as well. So how do they decide? I mean, why does Mr. Ram Prasad put 100% of his investments in bank deposits, and John Crenshaw is putting 100% of his investment in stocks, not only Tata Motors but in other stocks? Why is it that some people prefer to put their money in bank deposits which are less risky, and others are willing to put it in stocks which are more risky? What is the reason? We have actually explored this topic a little bit earlier in my introductory section, in the introduction to this particular segment, but we are going to do a deeper dive here. Not a deeper dive, but at least to understand some of the underlying concepts. So that has to do with the attitude towards risk of the investors, right? The attitude towards risk becomes important. What is their attitude? Do they have an aggressive attitude? Do they have a conservative attitude? Possibly Ram Prasad has a conservative attitude towards risk, and John Crenshaw has a more aggressive attitude towards risk. That is why John is willing to invest in stocks which are generally more risky, and Ram, on the other hand, is willing to invest only in bank deposits because he is conservative. He doesn't want to lose money. He wants to make sure that his principal is never going to get wiped out, right? And therefore, if he wants to play it safe, he will get lower returns. But he is happy because that is his psychological makeup. Whereas John Crenshaw is willing to take more risk. He knows that if he puts his money, his 100% of the money in the stock market, we know the stock market goes up and down, right? It might go up and it might come down. So he might lose the money as well. He knows that, but he is willing to take it up. He is willing to take on that risk because that is part of his psychological makeup. So we are trying to understand that. We are going to categorize the people into three buckets based on their risk preference or their risk attitude. And that will help us then, as part of the portfolio management, which is an important part of investment management, right? That's what these private bankers do, right? They advise you. So if you go to a private banker, what he will do is he will give you a questionnaire which will ask you a set of questions. Why? Because he wants to gauge your attitude towards risk. Based on his sort of estimate of your risk attitude or your preference, then he will recommend the appropriate stocks or appropriate bonds. Because suppose you are Ram Prasad and he says that you should invest all your money in the stocks, in the stock market, then Ram Prasad will say, this guy is not making sense, and he will simply walk out. If John Crenshaw, on the other hand, is told to invest his entire money in deposits, again, he is not going to like it. So we need to understand their risk attitude so that we can then match the securities or the investment options that suit them. So that is the idea here. That's the underlying idea here. So let's move forward. We will talk about risk attitudes. Let us state what is meant by risk attitude. To understand that, we need to define one thing, one term or one concept, which is called certainty equivalent. So let us understand what is meant by certainty equivalent, and then we will define the risk attitude or how to capture the risk attitude based on the certainty equivalent, based on this concept of certainty equivalent. Certainty equivalent means, as is stated here, the amount of cash or the amount of money that someone like Ram Prasad or John Crenshaw, in my example, right, someone would require with certainty at a point in time to make the individual indifferent between that certain amount and an amount expected to be received with risk at some point in the future. A great example of this is your Amitabh Bachchan, who comes on the show, right? Who wants to be a millionaire? Kaun banega crorepati? Right? So if you go on this Kaun Banega Crorepati or Who Wants to Be a Millionaire show, you have to answer a series of questions. If you answer the first question correctly, then you go to the next stage. And maybe as you answer one question, right, when you answer your first question correctly, who was the 6th president of India? And then you go blank, right? Then there's a problem. But if you're able to answer that correctly, and I don't know who the 6th president was, just a question that popped up in my mind. Let's say you answer that question correctly, you may get 50,000 rupees or 1 lakh rupees or whatever it is, and then you go to the next question. And let's say you progress to that, you go through 3rd, 4th, 5th, and then you've got a pile of money. You've got maybe 1 lakh rupees or 10 lakh rupees. And then Amitabh Bachchan says, if you answer this next question correctly, you will get 1 crore rupees. If you answer it wrongly, then whatever you have so far, the 10 lakhs or 20 lakhs or whatever it is, you will lose it. That's where this concept comes in of certainty equivalent. Either you are certainly going to walk away with the 10 lakh rupees, or there is a chance that by answering this question as to who is the 6th president of India, or whatever it is, the question that he is going to pose to you, if you answer it correctly, you might possibly get the 1 crore rupees. Some people, if they are willing to take the risk, they will say, it's okay, I will stake whatever it is, the 30 lakhs or 50 lakhs that I have won, I will take a chance. Others may hesitate. They may say that this 30 lakhs is good enough for me. That's like my 5 years of salary or something like that. So I'm not going to risk that. So I'm going to walk away with the 30 lakhs, right? So that's where the risk attitude comes in. A conservative person might walk away. A more aggressive person might be willing to take that risk. So what is that amount of cash that you need with certainty at a certain point in time to make the individual indifferent between that amount and this uncertain amount or that you are going to expect in the future? That is known as certainty equivalent. Okay, so I gave you some kind of a connection with Kaun Banega Crorepati. So hopefully you're able to connect what we are talking about. Let's look at a specific example, right, so that we understand this better. So we will first define the risk attitude with the expected value, the certainty equivalent and expected value. We will do a comparison to define the risk attitudes, and then we will look at an example. So if this certainty equivalent is greater than the expected value, then we say that that person is really having a risk preference. That means they are aggressive. Okay, these are the John Crenshaws that I mentioned earlier, right? Like my friend John and I used to work together in Capital One. I spent about 10 years or so in Capital One, which is a top 10 US bank, and so I might use his name now and then. Ram Prasad again is a good friend of mine. We had done schooling together, and he now works in Dubai. And I might use some other examples like that, some of my old students, some of my colleagues, friends, etc., just to hopefully make the class interesting and for you to connect with real people so that you understand the underlying concepts. Anyway, coming back, so if the certainty equivalent is greater than the expected value, then we say that they are an aggressive investor. Okay. And if the certainty equivalent is just equal to the expected value, then we say they are risk neutral. And if the certainty equivalent is less than the expected value, then we say that they have a risk aversion. That means they are conservative investors. So if we are able to gauge them like this, then we can recommend the appropriate product for them. That is the underlying idea. And indeed, what we see, what research shows is that most people are actually risk averse. They are not willing to take on risk, right? Because that's the nature of it. I mean, you worked hard to earn the money. So are you going to gamble it away? That's the question, right? At some point you will stop. Maybe when you're at the first question in Kaun Banega Crorepati, that is only 50,000 rupees you have won. And if you answer the second question correctly, you will go to 1 lakh rupees. I actually don't know the details. I'm just making this up. Maybe it is 1 lakh and 10 lakhs. I'm not sure. But whatever it is, 50,000 to 1 lakh, that seems like something that most people may be willing to take the risk. But when it goes from 1 to 10 lakhs, some people may walk away. When it goes to 10 to 15 lakhs, more people will walk away. When it is 50 to 1 crores, probably there will be only a few people who will be willing to take that risk, isn't it? So we can see that when you watch Kaun Banega Crorepati, you can see this actually playing out, that most people are actually risk averse. They are not willing to take such a big challenge because they may lose whatever they have made so far, right? So let's look at an example, specific example, so that we will be able to internalize this. Before we actually look at this example, one point I want to call out. We are actually just making a basic definition here. In practice, what will happen is that when you walk into the private banker's office, they will give you a questionnaire, which is an instrument through which they will try to actually assess whether you are aggressive, whether you are conservative, things like that. Okay, so it will be much more complex than what we are doing here. But this is to give you a feel and then to give you the overarching idea. So the idea is that they want to categorize you. They want to understand what is your psychological makeup so that then they can match the correct investment opportunity or the correct securities that would be suitable for your particular psychological makeup or your risk aversion or your attitude towards risk. Let us say we have a choice in this example between a guaranteed dollar reward, like in the Kaun Banega Crorepati. Let's say you have come to a certain stage where the guaranteed is not in dollars, this is rupees, let's say 30 lakhs. Okay, you have answered 4 or 5 questions. I don't know how many questions you need to get answered to get to 30 lakhs. You have done that. Now, the next question, we don't know what that is. It might be like, what is the, I don't know, I mean, it could be from the animal world, it could be from history, it could be about, science. We don't know the question, and we have no idea how difficult or how easy that question might be, right? The question might actually have to do with a particular disease, and suppose you are a doctor, you might know about it, right? If you are a scientist, you may not or may or may not know about it. So it might be about a historical building. Unless you are a historian, you may not know about it. So we cannot say with certainty what that question will be, how difficult it will be. So it is a gamble only, right? So it's a gamble. In this case, we are saying that it is a 50-50 chance. A coin flip means 50-50 because there are only two sides to the coin. When you toss the coin, you might either get a heads or you might get a tail, isn't it? That's what happens when, how do we decide whether India is going to bat or Australia is going to bat? The cricket series is going on now. So how do they decide? The captains go out and toss, and then based on one captain tosses, the other captain calls out. And so if he calls out heads and we get a heads, then they make the decision whether to bat or bowl, isn't it? So a coin flip is a 50-50 gamble. It's a 50-50 chance. Similarly, when you're on Kaun Banega Crorepati, that percentage might differ. It may not be 50-50 because we don't know what question is going to be asked. We don't know our level of preparation, right? Based on our preparation, based on our understanding, we may be at 50-50 or we may be much worse. But whatever it is, there is a certain gamble associated. There is a certain probability associated. In this case, it is 50-50 for this example. It is a 50% chance of winning $100,000 or 50% chance of $0. That is in this example. In Kaun Banega Crorepati, how does that translate? You got 30 lakhs with you, so you have a certain chance that you can walk away with 30 lakhs, or you have to take a chance and then you may get 1 crore, isn't it? So that's essentially how it works. So it is sort of similar. The context is somewhat similar. So depending on your risk attitude, you will make that decision. So we want to try and quantify it here. So what we are saying is, in this particular example, we either have a guaranteed dollar reward, the exact dollar amount is not mentioned, or we have a 50-50 chance of 100,000 versus $0. Now that guaranteed amount is we are going to look at 3 cases for that guaranteed amount. First is Ankita. The guaranteed amount that she needs is 25,000 to call off the gamble. That means if she is told $20,000 I will give, otherwise there is this gamble, she will go for the gamble. Okay, so if she is told we will give you $25,000 and $1 or $26,000, then she will say I don't want the gamble. That is Ankita. Ram is happy to take $50,000 or to take the gamble. Okay, so if you tell Ram that we will give you $50,000 or you can take the gamble, he'll say it's okay, either thing is okay, either way is okay. That is Ram. And then we have Raju, and Raju needs at least $52,000. Raju needs at least $52,000 to call off the gamble. So Raju, if you offer him anything like 48,000, he will not call off the gamble. He'll say, come on, toss the coin, right? But Ankita, if you tell her 48,000, she'll say, no, wait a minute, I don't want that coin toss, just give me the $48,000. That's Ankita. So now we want to categorize them into who is conservative, who is aggressive, and who is neutral. So for doing that, in order to do that, remember we have to compare 2 things, right? We have to compare the certainty equivalent with the expected value. The certainty equivalents are given. The certainty equivalent for Ankita is 25,000, the certainty equivalent for Ram is 50,000, and the certainty equivalent for Raju is 52,000. What we have to do is we have to calculate the expected value and compare it against the expected value. What is the expected value in this case? How do we calculate it? We have 2 possibilities, right? One possibility is $100,000 and it's a 50% chance, and the second possibility is $0 and there's a 50% chance. So how do you find the expected value? We know how to do that. We have seen that in the previous class. We take the probability and we multiply it with the return. That's what we did there. Here we take the probability and multiply it with the dollar amount. So we take 100,000 multiplied by 50%, we take $0 and multiply it also by 50%, and then add the two together. And what do you get? You will get $50,000, right? So we will then, so therefore what we are going to get here is 50,000. If you multiply the two, here you will get 0, and if you add these, you will get $50,000. So the answer is $50,000. So the certainty equivalent is different, but the expected value is $50,000, right? So that $50,000 we are going to compare with the certainty equivalent and then decide, and that will help us to decide who is risk averse and who is more aggressive. Let's see. Ankita, clearly, where is she? She is happy with $25,000, which is definitely below the $50,000, right? So when you look at Ankita, she is able 25k versus 50k, that is less. So therefore we can categorize her as risk averse. If you look at Ram, then you see that his 50k is his certainty equivalent, and that is equal to the expected value. So we can say that he demonstrates risk neutral behavior. And how about Raju? Raju gave a much bigger number. I think it was 52k. So his 52k is bigger than the expected value of 50k. So therefore he is showing a preference for risk. That means he is an aggressive not in terms of personal behavior, aggressive in terms of their financial risk taking ability. They are willing to take more risk, right? So accordingly we may be able to recommend to Raju, we can recommend to Raju that he can invest more money in stocks. But to Ankita, we have to be cautious. Still, some part of the portfolio should be invested in stocks, especially if there is a long-term horizon. And we'll talk a little bit more about that in portfolio in the portfolio section that is going to come up in a few minutes. But nonetheless, compared to Raju, Ankita is more risk averse, so we can't recommend the really risky securities to her. So that is the idea here. So we have talked a little bit about how to calculate risk. That is what we did earlier, right? How to quantify risk. Now we have talked about how to understand who is risk averse and who is not. But again, this is only scratching the surface. The actual private bankers will put you through. If you go as a customer, they will give you a very detailed questionnaire to assess where exactly you fit in and things like that. But this is to help you to get a sense of it, right? And the next thing that we want to do is we want to match these two, right? We won't go into those details because that would be part of an investment banking course. But what we want to do here is take a look at the possible opportunities. I gave you an idea earlier, and I told you that there are these stocks and there are these bonds, and then we have other securities as well. So what are those? So basically one set is the stocks, which are really the risky ones, and then we have the risk-free ones, or the government bonds, or less risky. So these are lower risk and these are higher risk. So if you look at the market, what we observe is that, so here in this first row we have the returns, and in this, that is the average returns, and then the second row we have the standard deviation. If you see, the small stock has the highest standard deviation. That means what? If you look at, so that means that the risk is highest over here and the risk is lowest over here, right? And you see that when the risk is high, the return is high. When the risk is low, the return is low. So this is clear empirical evidence. If you look at the market, there is clear empirical evidence that, what is the evidence? That risk and return go together, right? So that is the clear evidence. And so if you want higher returns, you have to take more risk, okay? And if you are willing to satisfy yourself with lower returns, then you don't have to take as much risk. That is the underlying idea here. So there is clear evidence by looking at the US financial markets. Why are we looking at the US financial markets? Because we have a history. We have a long history from about 1926 or so. Data is there till today. Okay, we have more than 80 years of data, and we can analyze that data. Whereas if you compare it with some other market, even in India, we have a fairly well established and structured financial markets. Our stock market is also quite old, the Bombay stock market and so on. So we do have data in India as well, but it is much more structured and much more reliable data is available, digitized data in the US. So generally we look at the US market as a benchmark. and we can see clear evidence between risk and return. If you look at Indian market also, you will see the same thing. It's not very difficult. Just look at the comparison between deposits, bank deposit rates with average returns from the stock market. Look at the NSE index or look at the BSE index. What was it in 2005? What is it today? And you can calculate the average return, right? And if you had invested in a bank deposit, that probably would have been 6 or 8%. Whereas if you look at the stock market, it would be at least 15% return. So the same evidence is there in India, the same evidence you will find in any market in the world, whether it is Singapore, whether it is Hong Kong, whether it is Dubai, whether it is London, whether it is Frankfurt, whether it is New York, it doesn't matter. We will see that there is a clear relationship between risk and return. The more risk you take, the higher the return you can expect to receive. So here are the lessons. Looking at the historical returns, what are the lessons that we can learn? There are two important points that I want to make here. One is that what we have just seen, that if you are willing to invest in riskier investments, then you will have higher returns. Okay, so that is one thing. And one point here is that I told you earlier that the benchmark for the risk-free return is the US Treasury bond. So the difference between our risky investment and the risk-free investment is known as the risk premium. That is called the equity risk premium. So here the treasury bill is our risk-free investment and the stocks are our risky investments. You can see the risk is almost negligible. It's 0.9%. So we can call that as risk-free. So the difference between these two is known as the risk premium. So 34.1%. That's the standard deviation. Let's look at the return. 11.7% is the return on the small stock, and if you subtract the 3.7% return on the treasury bill, that difference between the two, which happens to be 8%, is the risk premium. So the risk premium, that is the equity risk premium, based on the previous chart for small stocks, is what? We can see it is 11.7% minus 3.7%, which is equal to 8%. Okay. Similarly, is it 8% or 6%? Let's see. So it is 11.7% minus 3.7%. That gives us 8%. So this is not correct. So the small stocks, that was over government bonds. So compared to government bonds, that is correct. Actually, this is correct with government bonds. What I have done here is with treasury bills. With treasury bills, the premium is 8%. With government bonds, it is 6%. Okay. So that is called as the equity risk premium, something that we will be using later. What is that? What is that telling us? It is telling us what is the extra return or the premium that we are going to get for taking on extra risk, right? That is what the equity risk premium is telling us. So compared to the treasury bond or the treasury bill, which is over here, which is almost zero risk, if you take more risk, how much more return can you expect? That's what the premium is telling us, right? So that's an important metric which we will use elsewhere in the capital asset pricing model, which we will be discussing a little later. Lesson number 2 is that the historical returns of higher risk investment classes have higher standard deviation. That we can see. For example, the small stocks, we had looked at it. That was 34.1%, right? If you look at large stocks, that is 21.4%. Compared to the 0.9% for government bonds or T-bills, that is much higher. So therefore, higher returns means higher risk. That's the point. The point is very simple. The point is that risk and return go together. This is a fundamental point, fundamental principle of finance, very important principle in finance that you should never forget. Risk and return go together. What we have said, let us take stock. What have we talked about so far? We have seen how to calculate, how to quantify the risk and return. Right? We have seen that. We have done that. We have looked at various examples and so on. Then we have talked about risk attitudes, right? So we have looked at an example of how to categorize a person as aggressive or conservative and so on. Then we have looked at the market for empirical evidence and we see that indeed if you take more risk, then you will get a higher return. That means what we have seen is that risk and return go together. This is what we have seen within risk management so far. These are the things that we have discussed. Now what we are saying is that, okay, we understand that John Crenshaw is willing to take more risk, so he can invest in more risky stocks. Whereas Ram Prasad is a little bit conservative. These are the two people I talked about earlier. And he is not willing to put all his money in risky assets, and he wants to put it in bank deposits. But is there a via media? Is there sort of a compromise that we can achieve? Is there some way that we can offer something better to Ram Prasad rather than simply bank deposits? And the answer is yes. Through portfolio theory, what is known as portfolio theory or modern portfolio theory, we can actually provide some sort of a compromise or some sort of an optimization for Ram Prasad, which will allow him to get a better return than just the risk-free rate, but without taking on too much risk. That is possible through portfolio diversification. And the underlying theory is called portfolio theory, and the concept here is of diversification. What does that mean? And what are the returns of the diversified portfolio? What is the risk of the diversified portfolio? That is what we want to talk about next. Okay. So what does diversification mean? Diversification means that instead of having just one asset, we will add other assets to the portfolio. Instead of buying just one stock, we will buy more stocks, or we will have a stock, we'll have bonds, we'll have something else, right? So that is called diversification. And how does diversification help us? How can diversification benefit us? The reason is very simple. Suppose we are investing in one asset, right? And this is time, and let's say this is our portfolio value or our value of our investment. If it is only one investment, that's the value of our investment. And let's say it does something like this. It goes up and down like that. That's our particular investment. We have invested in Tata Motors and it is doing something like that. Okay. Now, let's say we are going to invest in another security. Suppose let us take some other security. It could be bond market. It could be another equity, or it could be something else. It doesn't matter. We are going to invest in another security. And let's say that security is going to give us a return like in this blue line. Okay. What is it doing? There is also risk in this. So in both the cases there is risk, right? You can see that because it is varying. If it is a straight line going up, then we can say that there is no risk. But since the line is fluctuating, it's going up and down, that means there is risk, because risk, remember, is variability. Variability around the expected value. Expected value is the average. So whenever there is variability, that means there is risk. So there is risk when it comes to this red line. This is our asset 1. And there is risk when it comes to our blue line, which is our asset 2. Both the cases there is risk. We can see that because there is fluctuation. But look at what happens when you add both of them together. When you add both of them together, the result is a straight line that we get. Because when the red line is going up, the blue line is coming down. When the red line is coming down, the blue line is going up. We call this as negative correlation. So when two assets are negatively correlated, then the variability can potentially be cancelled out. They can cancel each other out. And then what will happen? We will end up with almost zero risk or close to zero risk. That is the idea behind diversification. That is, if you have one asset and you add another asset which is negatively correlated, or at least not perfectly positively correlated. What is perfectly positively correlated? What does that mean? Suppose I am having this red line as I have already drawn, and suppose we have one more security which I am going to represent with a green line now, and suppose that is going to follow very closely this red line. It's going to follow this red line very closely. Then we say that the red and green, for example, are perfectly positively correlated because they are following each other. Okay, so if they follow each other, so when you look at the red and blue, what happens? They are negatively correlated. When you look at the red and green, what happens? They are positively correlated. There is positive correlation here. So if they are positively correlated, then we cannot get any benefit of diversification, because when this is going up, that is going up, and when red is going down, green is also going down. So we cannot, there is no escape, right? Both are either going to tank or both are going to go up. So that is not diversification. But if they are not positively correlated, they need not be perfectly negatively correlated. Like in my example, whenever red is going up, blue is coming down. Whenever red is coming down, blue is going up. That's perfect negative correlation. It need not be perfect. Even if it is imperfect, provided it is not positively correlated, there will be some benefit to diversification. What that means is that it's not as complex. All it means is that if one security is not doing well, somebody else will make up for it, right? And if that one which was making up is now not doing well, another one will make up for that. That's the idea of diversification. So instead of putting, we say, right, don't put all your eggs in one basket. That's sort of the idea here, right? That's an English saying. So something similar to that. Basically what we are saying is, instead of investing in one particular stock, we are going to diversify into many different stocks. If in 1978 or whenever it was that Bill Gates came up with the idea of starting Microsoft, if you knew that Microsoft is going to be a huge success and you write a check of say $10,000 to Bill Gates, that $10,000 today might be 10 million or 10, I don't know, it might even be $1 billion. I don't know. At the time, probably when Bill Gates started, that entire company might not even be worth more than $100,000. So if you had given a check of $10,000 to Bill Gates at the time, that probably would have been worth 6 or 7 or 10 billion dollars today. But we don't know that. So therefore, what do? Well, we should diversify. We should invest in multiple stocks. We don't know which stock will actually win, but if you invest in multiple stocks, then what happens is, when one is doing well, the other may not do well, right? But you will, at least on average, you will be able to even out. So that's sort of the idea of diversification. So basically the underlying point behind diversification is what I have represented in this simple chart. That is your red line and your blue line, right? But if you have the red line and the green line, then that's a problem. That doesn't lead to diversification. Okay. But the red line and the blue line, or the green line and the blue line, those are negatively related, and that sort of a combination can lead to diversification. So asset 1 is our red line, asset 2 is our blue line, and asset 3 is our green line. Okay. Just to be clear. So red and blue is negative. Similarly, green and blue is also negative. Okay. So green and blue is also negative. So such a correlation. So if you have assets like that in your portfolio, then we can reduce risk. That is the underlying idea behind portfolio diversification. So now we are going to look at how to calculate the expected return of the portfolio. So how do we do that? Well, suppose we have 3 assets in the portfolio, right? So as we discussed, let's say we have 3 assets, asset 1, asset 2, asset 3. Then what do? Well, we will look at how much we have invested in each asset. That is called the weight. Okay. So suppose we have invested 50% of our money here, and we have put 25% here, 25% here. Then let us say we can calculate what are the returns of each of these assets. Like the Tata Motors example, you can download the data and you can calculate the average return, right? You can download the stock prices, you can calculate the daily returns, and then you can find the average of those returns. So let's say we have done that, and then we got some numbers. Let's say for asset 1, it turns out to be 15%, for asset 2, it turns out to be 10%, and for asset 3, let's say it turns out to be 5%. Then how do we calculate the return of this portfolio? What is the expected return of the portfolio? It is simply a weighted average. This is another type of average. All we are doing is we are going to take the weight and multiply it by the return, and we will do that for asset 1, asset 2, asset 3, and then we are going to add it up, right? This is like the discrete probability example, right? The same thing, same concept. Instead of probability, we are going to use weight. Okay, so we will take the weight of asset 1, multiply by return of asset 1, weight of asset 2, multiply by return of asset 2, weight of asset 3, multiply by return of asset 3, and then add all those multiples, all those products together, and that will give us our expected return of the portfolio. In this case, what is it? If you take 50% and multiply by 15%, you will get 7.5%. That will be the first one. So we have to sum all these. So first one will be 7.5%. Second one, 25% of 10%, 25% into 10%, that will be 2.5%. And then 25% of 5%. What might that be? That is a quarter. 25% means 1/4 of 5%. 1/4 of 5% is 1.25%. Okay. Some little mathematics somehow I can do in my head. Hopefully, by building analytical skills, you should also be able to do that. This is not very difficult, but if you need, you can use a calculator to verify what I have done. So if you add all this, 7.5 plus 2.5 is 10 plus 1.25 will give me 11.25%. That would be the expected return of this particular portfolio. So that is how we would calculate the expected return. Okay. Then how do we determine the risk of the portfolio? Is it also the average? That is the weighted, this is called weighted average. What we have done here is called weighted average. We call this as weighted average. What did we do? We took the weightage. How do we get the weightage, by the way? The weightage is based on the amount of money, the market value of that investment. Suppose we have invested $100,000 and suppose we put 50,000 in asset 1, we have put $50,000. In asset 2, we have put $25,000. In asset 3, we have put another $25,000. That means totally we have invested $100,000. So 50,000 out of 100,000 means 50%. 25,000 out of 100,000 means 25%. Another 25,000 out of 100,000 means 25%, and the total is 100%. Right? So that is how we calculate the weight. And if you this method, so basically we are taking the weighted average, and that weighted average is giving us the expected return of a portfolio. My question to you is, can we take the weighted average of the standard deviations, and will that give us the weighted average of the portfolio? In other words, by taking a weighted average of the standard deviation, will we be able to get the risk of the portfolio? Think about that, right? The answer will come in the next session of this class. Thank you very much. Bye for now.